The United States has embarked on a new era of trade policy, characterized by the implementation of significant tariffs on goods from various countries, most notably China. These tariffs, essentially taxes on imported goods, have sent shockwaves through the global economy, creating uncertainty and volatility in financial markets worldwide. The current situation stems from a complex web of factors, including concerns over intellectual property theft, unfair trade practices, and a desire to protect domestic industries. The U.S. administration argues that these tariffs are necessary to address long-standing trade imbalances and protect American jobs. They contend that countries like China have engaged in practices that harm U.S. businesses and workers, such as forced technology transfer and currency manipulation. By imposing tariffs, the U.S. aims to level the playing field and encourage fairer trade practices. However, these actions have not come without consequences. The immediate impact of these tariffs has been felt most acutely in the global stock markets, which have experienced significant volatility since the tariffs were announced. The financial world watched with bated breath as the United States imposed new tariffs on $50 billion worth of Chinese imports, targeting key sectors such as electronics, machinery, and auto components. This action, the latest salvo in an ongoing trade war, sent shockwaves through global stock markets, triggering a wave of selling and erasing billions of dollars in market value. The Dow Jones Industrial Average, a closely watched barometer of U.S. stock market sentiment, plummeted by 2.3% in a single day, marking its most significant decline in 3 months. The S&P 500, a broader measure of the U.S. stock market, followed suit, shedding 1.9% of its value. The technology-heavy Nasdaq Composite Index suffered the most significant blow, plunging by 3.1%. This dramatic sell-off was not confined to U.S. shores. Stock markets around the world tumbled in response to the escalating trade tensions. The Shanghai Composite Index, China's benchmark stock index, plunged by 2.7%, while Hong Kong's Hang Seng Index plummeted by a staggering 3.4%. European markets also felt the heat, with the Stoxx Europe 600 Index, a broad measure of European stock performance, falling by 1.5%. While the initial shock of the tariffs reverberated across global markets, certain sectors have borne the brunt of the impact more acutely than others. The technology sector, heavily reliant on global supply chains and cross-border trade, has emerged as one of the most vulnerable casualties in this trade war. Apple Inc., the world's most valuable company, and a bellwether for the tech industry, saw its stock price plummet by 4.2%, as investors fretted over the potential impact of tariffs on the company's vast supply chain, which relies heavily on Chinese manufacturing. NVIDIA Corporation, a leading manufacturer of graphics processing units widely used in data centers, gaming PCs, and artificial intelligence applications, experienced an even steeper decline, with its stock price tumbling by 5.1%. The automotive industry, another sector heavily reliant on global supply chains, has also been caught in the crossfire. General Motors, one of the world's largest automakers, saw its stock price decline by 3.8%, while its rival Ford Motor Company experienced a steeper drop of 4.5%. These declines reflect growing concerns about the impact of tariffs on the cost of imported auto parts and the potential for retaliatory tariffs from China, a major market for U.S. automakers. The impact of U.S. tariffs extends far beyond the confines of Wall Street, reverberating throughout the global economy and influencing a wide range of economic indicators. From supply chains to recession risks, the ripple effects of these tariffs are being felt across the globe. One of the most significant impacts has been the disruption of global supply chains. Businesses that rely on components or raw materials sourced from China are facing higher costs and delays as tariffs increase the price of these inputs. This disruption is forcing companies to reevaluate their supply chains, with some exploring alternative sourcing options or shifting production to other countries. The tariffs have also heightened fears of a global recession. The International Monetary Fund, or IMF, a key international organization that promotes global financial stability, has downgraded its global growth forecast to 3% from 3.2%, citing trade tensions as a key factor weighing on economic activity. JP Morgan Chase and Goldman Sachs, two of the world's largest investment banks, have both estimated a 50% chance of a U.S. and global recession in 2025, citing the escalating trade war as a significant risk factor. The implementation of tariffs has ignited a fierce political debate within the United States, highlighting deep divisions over trade policy and its implications for the American economy. While the current administration defends the tariffs as necessary to protect American jobs and intellectual property, critics argue that they are counterproductive and harmful to both consumers and businesses. Democrats have voiced strong opposition to the tariffs, arguing that they will lead to higher prices for consumers, job losses in industries reliant on imports, and retaliatory tariffs from other countries that will harm American exporters. Some Democrats have even called for a Securities and Exchange Commission investigation into potential insider trading, alleging that some individuals may have profited from advance knowledge of the tariff announcements. The White House maintains that the tariffs are necessary to address long-standing concerns about China's trade practices and that they have bipartisan support. However, the divisions within the business community suggest otherwise. While some industries, such as steel and aluminum, have welcomed the tariffs as a way to protect themselves from foreign competition, others, such as retailers and manufacturers that rely on imported components, have expressed concerns about the negative impact on their businesses.